Okay, this is a really good exercise. There's a couple chances for us to do a couple of different things. First, it tells us that all of these things were made to one account called intangible asset. And we have to go through and we have to break this up. So that's going to be called organizational costs. Okay, and that's an expense. Fire insurance, that's prepaid insurance. That's an asset. We purchased the copyright, so that comes on as a copyright, and that's an asset. Research and development costs, they're expensed as incurred. Legal fees for filing a patent, well, we can include that as an asset. And we had to defend that patent in court, so we can bring those on as a patent together. Franchise comes on as an intangible asset. And various advertising expenses are just that, expense. And then we acquired all of the common stock of this company for $690,000. That's going to get interesting. Let's do the first ones first, okay? So we're going to just go down the list here. Organizational cost, $9,000. Prepaid insurance, $7,000. That's an expense. That's an asset. And the copyright was $39,000. Remember the $7,000 that we bought that purchased the copyright, okay? So we bring that on there. That's an asset. Research and development expense, and that's just an expense, $59,000. And then patent, that was the one we developed and defended, that's $38,000. And franchise, that's an asset. So that's an asset. This is an asset. And that's $59,000. $59,000. Advertising expense was $35,000. And remember, they had brought it all on. It was all in one account called intangible asset. So an intangible asset would carry a debit balance. We need to bring it out of there. That's a credit balance, and that totals $246,000. So we have to credit that intangible asset as we move these things to the correct accounts. Now let's take a look at this company that we bought for $690,000. Here's the information on these guys. Okay. So for $690,000, we got receivables of $195,000, equipment, patent. So we got $885,000 worth of assets, and we assumed a note payable. So the net assets, the total assets that we acquired minus the liabilities we assumed, are the net assets of the company. We paid $690,000 for $475,000 worth of net assets. That gives us goodwill, excess of purchase price over fair market value, $215,000. So let's bring that on. So we're bringing on the receivables. That's an asset. We're bringing on the equipment, also an asset. We bought a patent, also an asset. We have goodwill that we calculated, $215,000. We assumed a note payable of $410,000. And we have to, again, this was all in that one account, one asset account called intangible. We have to credit that for the $690 to take it off the books. Okay? The only thing that was a little bit new, was you had to calculate goodwill, which was the excess of purchase price over fair market value.